Yeah, hi, welcome to another case study. This one is in the name of Garth and Tania. So let's take a look at what this one's all about, shall we? 5 years ago, Garth and Tania took out a £70,000 joint repayment mortgage with Ross on Y, Equitable Building Society. Okay, so that's repayment mortgage. At that time, Garth was earning 24,000, Tania 6, and no mortgage indemnity guarantee policy was required. That's the high lending charge. Since then, the REBS, that's the building society, self-insure the risk. In other words, they don't require a high lending charge. 6 months ago, Tania's father Alan moved in after his mother's tragic death. That's very sad, isn't it? Okay. They now plan to build an extension and are in the process of applying for a further advance of £32,000 from the Ross. Alan, who's the father, is donating £5,000 to the cause. Very generous of him, isn't it? Last month, Tania decided to give up work to look after Alan full-time due to his muscle deterioration disease, which has now made him totally dependent on Tania's care. His only income is his Merchant Navy's pension of £8,000. Could we take that into account? Possibly. Unlikely, though, would they take that into account. When they first started the mortgage, the house was worth £118,000. However, due to fall in house prices over this period, it is now worth £110,000. Okay, so let's get some figures written down. I'm writing these down now because I need to. And they're hoping the extension will increase the value. So they've got a £70,000 repayment mortgage. It was taken out 5 years ago, so it would have reduced by a little. Not much, but it would have reduced by some. Garth has just taken out a car lease at £250 a month for 3 years, and he wonders how this might impact his application, which is going to affect his affordability because that's a committed expenditure. So let's take a look at the questions, shall we? Interesting one, this, isn't it? Okay. In terms of the Consumer Credit Act 2006, the further advance applied for is deemed... Okay, well, we're talking here about the numbers, aren't we? The figures, the 25,000, which is no longer relevant. But the answer to this one would be B. It's exempt from the Consumer Credit Act, which is answer B there for you. Okay. If the advance was £10,000 lower under the Consumer Credit Act, the classification would, well, in this situation it does change it, doesn't it? It comes down to C, remain the same. The thing is, of course, mortgage loans are no longer regulated on the Consumer Credit Act, aren't they? They're exempt because it's to purchase a property or to improve a property. So that's where they're going with this one. These of course, are all regulated by the MCOBs and the FCA. Tacking of the further advance. Now this is only required tacking, if you can remember, if there's a second charge already registered against the property, and then what you do is you tack your further advance lending on top of the first charge in priority to the second charge. But there's no second charge in this particular case study, so it is not appropriate in this case. That's fair, isn't it? I don't think we need to look at the other answers there, do we? The REBS have changed their policy now and charge for an indemnity guarantee policy. Okay, so they've now decided to do it, where the further advance exceeds the loan to value ratio of 75%. Okay, so let's just take a look at some of the numbers before we go into this one. They're looking to take out a further advance of 32,000. Alan's donating 5 to the cause. So obviously the extension is costing 37. So if they're looking to borrow another 32,000, that brings their total borrowing from what I have here to 102,000. Now 102,000, I'm going to work out the loan to value on this one. I make it 92.7%. We'll call it 93% for French. So back to the question then. They've changed their policy. They now require a mortgage indemnity where the loan to value exceeds 75%. Well, it will in this situation, wasn't it? So we've got a few options going on here for number 4. There is going to be a higher lending charge. 75% is the basic threshold. So if I put in there the value of the property, 110, that's what's valued at the moment. If I multiply that by 75%, that gives me 82,500, which is fine. Now that means anything above that is going to be charged a mortgage indemnity. Now they're borrowing 102, or hopefully going to, less the 82,500. That then gives me £19,500 is the amount of the high lending charge. And hopefully there's an answer. There we are, B. That is the correct answer, which is the correct answer. So that's the indemnity high lending charge calculation. Just got to know your figures, haven't you, for that one? Number 5, the decision taken by Tania. So what was the decision? She decided to give up work, didn't she, last month, and look after Al, because he's totally dependent. So the decision taken by Tania last month, A, will ensure she received disabled carers allowance. Well, there are allowances available, of course, to people, but it won't insure it. There are some conditions and things. B, will ensure that income confirmation is not required since the further advances for home improvements. No, that's rubbish. Further advances, they always require income confirmation. C, could affect whether or not the lender requires a property valuation. Well, it makes no difference. The valuation is irrelevant on who's living there. It's the property, it's the bricks and mortar they're valuing. D, may require that Alan's income is brought into the equation. Yeah, that's the right answer. Al's got his pension, hasn't he, from the merchant seaman, and therefore he might want to bring that into the mortgage, become part of the mortgage itself. Yeah, so D would be the right answer there. Let's highlight that one for you. Number 6. In order for the lender to grant the additional loan, Alan will be required to. Now, Alan, remember, is not on the mortgage, but he's living in the property. And we've got a few options here, haven't we? A, sign a consent to mortgage form. Well, he will need to do that. The lender knows about him. He's living in the property. He's not on the mortgage yet, so he'll need to sign that consent to mortgage form because he's over the age of 18. B, seek independent legal advice. Well, he won't be required to do that. He's not a guarantor, so you can't require that. C, submit details of his income to the DWP. No, that's up to him if he does that. Or D, provide details of his income. Not necessarily. It may well be that the two people on the mortgage will remain, Garth and Tania will remain on the mortgage, and Garth's income may well be sufficient to pay the loan, so you don't need to provide details of the income. So A is the right answer. Interesting one. Number 7. When processing the new loan application, the statutory obligation is placed on Garth and Tania's lender too. So statutory means the law. So what is it they need to do, really? Well, there's a number of things they need to do, and the important one, of course, is to value the property. So let's take a look at what options we've got here. Ensure a re-inspection of the extension is carried out. We don't have to do that. If you value the property up front and there's enough there, you don't have to re-inspect the extension. B, ensure building regulations are followed correctly. Well, that's not down to the lender. That's down to the building regulation people at the local council. The building planning people, the building regulations people, they will want to check that it's being followed correctly with the builders. C, check the adequacy of the security. I like that one. You do that, of course, through evaluation. D, obtain written corroboration of income. Again, it's not statutory. You don't have to write to the employer for income references. There's no statutory requirement for that. So C is the right answer. Okay. 8. With regards to the car lease, that's an interesting question, isn't it? Now, you've got your 3 different types, haven't you? Committed, basic essential, and quality of living expenditure. Now, if it's something which you are committed to under contract, that's committed expenditure. And the car lease, quite clearly, is a contracted loan, and he has to make those payments. I think it's 3 years, isn't it? So I can already see the answer there, which is C, view it as committed expenditure. It's not quality of living. It's not basic essential. Disregard it for the purpose of the application. Well, they're not going to disregard it, are they? Because it's a large amount of money each month that he's paying on for his car. So it's committed expenditure. Okay, number 9. If the further advance fails to be granted, okay, so they may not decide to do it, this could result in, okay, so they've refused the further advance. What's going to happen now then? A, an entry being placed in the CML declinature register. There's no such thing. B, Alan acquiring an overriding interest in the property. That's coming my way. That's why they have the consent to mortgage form signed, you see, to stop the person who's living as a tenant, if you like, from taking ownership of the property if there's ever a repossession. So I quite like B, because he will, because he's not part of the mortgage, is he? C, the original loan being reclassified as exempt under the consumer credit. Well, it's always exempt anyway. D, a deed of postponement being issued to Garth and Tania. Now, this would be only in the event of a second charge, and you get the second charge lender to sign the deed of postponement because you're postponing the second charge. So B is the right answer there. Alan acquiring an overriding interest. Last question then. What have we got for this one? Number 10. Garth and Tania have looked into obtaining finance from the Pistol Bank PLC on a Pune basis. Well, a lot of people pronounce that Pwisney, don't they? But it's Pune. They explain that in the event of default, they have the right to. This is a very interesting question, isn't it? Because a Pune mortgage is effectively a loan without security of the deeds of the property. And second charges don't have the deeds because the deeds are stored with the first charge lender, aren't they? So a second charge would be a Pune. I love that phrase, don't you? So A, instigate repossession proceedings only if the loan with REBS is also in default. Note, second charge lenders can instigate their own repossession procedures if their loan hasn't been repaid. So that's not correct. B, repossess the property regardless of the REBS mortgage conduct. Yes, they can. They can do that. Obviously, the payout is shared amongst the first lender first. C, add their loan to the first lender's loan under their consolidation rights. A clever little red herring, that one, isn't it? Again, you won't have consolidation rights because you've got two separate lenders here, haven't you, rather than the one. D, insist on their own buildings insurance to be affected. No, second charge lenders can't do that. The first charge lender gets the buildings insurance wrapped up. So B would be the answer. That's an interesting one. If you knew what a Pune mortgage was, you'd be fine with that one, wouldn't you? If you had no idea, then it might confuse you. Great, so there we have Garth and Tania. Let's hope they can get that extension built. Al can move in and Tania can look after Al and they'll all live happily ever after. Isn't that what life's all about? Hey, hope you found that useful.